Artificial intelligence is rapidly becoming one of the most powerful forces shaping the global economy. From automated logistics systems to predictive analytics, companies are racing to integrate AI into their operations. Billions of dollars are flowing into AI infrastructure right now, from massive data centers to machine learning systems. But here's the catch. Most investors are chasing the same handful of giant AI companies everyone already knows. Meanwhile, a completely different layer of smaller companies is quietly building technologies that those systems actually depend on. And this is the part most people miss. Some of those companies are still trading at just a few dollars per share. Today we're looking at two such companies. One is trading around $2.10 per share. The other sits close to $5.44 per share. Both operate in technology areas connected to the expanding AI economy, but they remain largely under the radar. So the real question becomes, are these simply small companies in crowded industries? Or could they represent overlooked parts of the AI technology stack? Now this is where things start to get interesting. Whenever a major technology wave begins, whether it's cloud computing, mobile, or AI, investor attention tends to focus on the biggest players first. But beneath those well-known companies is an entire infrastructure layer. And this is where pricing inefficiencies often appear. Because large institutions and professional investors frequently analyze not just headline companies, but the smaller technologies enabling specific functions within the broader system. For example, AI models require enormous data processing capacity. They require memory systems. They require specialized algorithms to analyze patterns across massive data sets. But here's the part most people miss. Many of the companies building those layers remain small and relatively unknown for now. This doesn't guarantee anything, and small-cap companies carry significant risk, but it explains why certain niche technologies quietly attract institutional attention long before they reach the broader market. And this is exactly where smaller-cap opportunities tend to form. The first company operates at the intersection of AI and digital marketing infrastructure. Instead of building AI models themselves, it analyzes massive consumer data to predict intent and behavior patterns. In other words, its technology attempts to understand what people are likely to do online before they actually do it. And that's becoming extremely valuable in a world where AI-driven marketing systems are trying to make decisions in real time. But here's the catch. The company isn't a massive advertising platform like the giants dominating the industry. Instead, it operates more like a specialized intelligence layer, helping businesses understand how consumers behave. And later, the second company we'll discuss takes a completely different approach, one that involves hardware and advanced memory technology. Digital advertising is becoming increasingly dependent on artificial intelligence. Machine learning systems now analyze billions of data points. But as privacy rules evolve and third-party data becomes more restricted, companies are looking for new ways to understand consumer intent. If AI-driven marketing systems continue expanding, then technologies capable of predicting behavioral patterns from complex data sets could become increasingly valuable. Because companies that can interpret consumer signals more efficiently gain a major advantage in the digital economy. Looking at the stock itself, the price history has been far from stable. At earlier points, the shares traded at significantly higher levels. Over time, the stock experienced volatility and eventually declined before stabilizing at much lower prices. Today, it's trading around $2.10 per share. So the key question investors often ask in situations like this is simple. Is the current price simply reflecting past struggles? Or could the market be underestimating the potential of its technology in an increasingly AI-driven advertising environment? The company generates revenue by providing AI-powered advertising and data intelligence tools to businesses seeking to improve marketing performance. Its platform processes large volumes of data to identify patterns that help advertisers target audiences more effectively. But this is where things shift. Because when you actually look at the company behind this technology, it turns out to be Inuvo Inc., trading under the ticker INUV, currently priced around $2.10 per share. Smaller companies in competitive industries often take years to prove their long-term viability, and in digital advertising, competition is intense. So this doesn't mean the stock suddenly moves tomorrow. There are real risks here, and timing is often the biggest factor. Now, before we get into the second stock, here's something most people completely overlook. Even though AI adoption is exploding across industries, some of the companies building the hardware layer behind AI computing remain surprisingly small. And that's where the second company becomes interesting. But unlike the first company, which operates in AI-driven data analysis, this second company sits closer to the hardware side of the AI ecosystem. Instead of analyzing data, its technology focuses on how data is stored and processed within high-performance computing systems. And that becomes incredibly important when AI workloads scale. Artificial intelligence models require massive amounts of memory to process information efficiently. From recommendation engines to complex machine learning systems, AI applications constantly move enormous datasets between processors and memory. This company develops specialized memory technologies designed to improve how those systems handle large data workloads. If AI adoption continues accelerating across industries, then high-performance memory solutions could become increasingly important for enabling those systems to operate efficiently. Because without fast data access, even the most advanced AI models struggle to perform at scale. Looking at the stock history, the shares have also experienced periods of volatility. At times, the company traded at higher prices before declining and eventually stabilizing. Today, the stock sits around $5.44 per share, which raises the familiar question investors often ask. Is the current price simply reflecting uncertainty or potential future relevance in the expanding AI hardware ecosystem? And this is where it gets interesting, because the company behind this technology is GSI Technology, Inc., trading under the ticker GSI, currently priced near $5.44 per share. Semiconductor development cycles can be long and unpredictable. Technological breakthroughs don't always translate into immediate commercial success. So again, this doesn't guarantee anything. There are real risks here, especially with smaller companies in highly competitive tech sectors. So now the interesting comparison appears. The first company operates in AI-driven advertising and behavioral data analysis. The second focuses on memory technology supporting high-performance computing systems. One sits around $2 per share, the other around $5. But here's the real tension investors think about. If AI adoption accelerates rapidly, which type of company benefits faster? A software-driven data intelligence platform helping businesses interpret consumer behavior? Or a hardware-focused company working on memory solutions? Both scenarios depend on completely different market forces, and both come with very different timelines and risk profiles. The broader takeaway here isn't predicting short-term stock movements. Instead, it's understanding how technological revolutions often involve multiple layers. Artificial intelligence isn't just about software models. It's also about data interpretation systems, specialized computing hardware, and infrastructure. And this is the layer of the market that tends to move later, but sometimes more aggressively if adoption accelerates. If you enjoy exploring smaller companies connected to emerging technology trends, consider subscribing for more research-driven breakdowns like this. And as always, this discussion is for educational purposes only, not financial advice.